What's going on, everyone? Welcome back to Courtside Financial. It is Monday, October 27th, and we've got some interesting things to talk about. Last week, we covered the 70-day countdown to NIO's Q4 profitability deadline. We talked about the stakes, the risk, and really just the make it or break it nature of this moment. And a lot of you had feelings about that, which I respect. But today, we're talking about something that happened while we were all watching. I'm talking about institutional money moving in the background. RWC Asset Management Group just announced that they bought $14.5 million worth of NIO shares in Q3. And here's the kicker. They went from owning nothing to this basically being a $20 million position for them, accounting for around 1% of their portfolio. So the question that we're posing today is, what made them go from not interested to, hey, let's bet $20 million on these guys? Let's break it down. First, let's start with the facts because context matters. RWC Asset Management filed with the SEC on October 27th. That's literally today. During Q3 2025, they purchased 2.7 million shares of NIO. Based on the average price during that quarter, that's about $14.55 million worth of a purchase. Now, they already owned a tiny position worth about $100,000. But during Q3, they scaled that position up to $20.83 million in total. That's a 200x increase. They didn't just add to a position, they built a position. As of September 30th, NIO now represents just over 1% of their total assets under management. For perspective, their entire portfolio is around $2 billion. So we're not talking about some small rounding error here. Now, 1% doesn't sound like a lot, but let me give you some context on RWC's entire portfolio because this matters. Their top 5 portfolio holdings are $195 million in Macy's. That's about 9.5% of their portfolio. HP, $160 million, that's 7.7% of their portfolio. Exelon, $88 million at 4.3%. Lear, $57 million at 2.8%. And Cisco, $52 million at 2.5%. Notice something, these are all mature, established companies. Macy's, HP, Cisco, these are not majorly speculative bets. These are value plays, turnaround stories, and dividend payers. And then there's NIO at 1%, a Chinese EV startup that's 70 days away, less than 70 days now. I keep saying 70, but away from a make it or break it profitability moment. So clearly this tells you something about the company's conviction in NIO. So let's talk about why they bought more and more importantly, when. They bought during Q3 2025. That's July, August, September. Let me remind you what's happening during that time. In July, the Envo L90 launched, and it was immediately clear this thing had product market fit. Strong orders right out the gate. August, NIO had record deliveries. The momentum was building. This wasn't just one good month. This was a trend forming. September, 34,749 deliveries, up 64% year over year. The new ES8 launched and within 10 days had 150,000 test drives. The Firefly was approaching 6,000 monthly sales. So RWC wasn't buying NIO at rock bottom in February when sales were 1,470. They were buying after the turnaround was clearly underway. This is important because it tells you exactly what kind of bet this is. This isn't a contrarian value play on a beaten down stock. This is a fundamentals are inflecting and we want exposure to this upside play. In the Motley Fool article that I read, I think they've got it right. They said RWC is predicting that the sales volume increase likely is providing some early visibility of profitability. So the translation is that they think NIO can actually pull off Q4 profitability, or at a minimum, they think that the market will re-rate the stock once that becomes obvious. Now let's talk about the second story today because it tells us a little bit more about why institutional money might be more interested in NIO. NIO just hit 90 million cumulative battery swaps. They crossed this milestone on October 26th, which was yesterday, just 100 days after hitting 80 million battery swaps. Let me give you the progression because it shows acceleration. First, 1 million swaps took 29 months. 10 million million swaps July 2022, 50 million swaps August 2024, 60 million swaps December 2024, 70 million swaps April 2025, 80 million swaps July 2025, 90 million swaps October 2025. They're now doing over 100,000 battery swaps per day. The 100 million swap is expected around January 2026. Now here's why this matters beyond just impressive numbers. This represents 4.75 billion kilowatt hours of electricity dispensed. That's enough to power 2.37 million households for a year. But more importantly, this is infrastructure that creates a moat. Every swap station is a fixed asset. Every swap performed is revenue. Every user who experiences the convenience becomes stickier. And here's the thing, yes, the infrastructure is expensive to build, but it becomes more valuable at scale. The first million swaps took 29 months. The jump from 80 to 90 million took only 100 days. That's what economies of scale looks like in real time. Now, the third story is interesting because it's about potential more than reality. A new survey shows that more than half of US prospective EV buyers would consider buying a Chinese EV like a BYD or a NIO. That's a significant increase from previous years. But, and there's a big but, there's massive data privacy concerns. The US government is investigating whether Chinese EVs pose a threat to national security, and their justification is that these cars are basically rolling computers on wheels that collect vast amounts of data. South Korea is expressing similar concerns. The fear is that under Chinese laws, Chinese companies would be compelled to share data with the Chinese government. Now, here's my take on this. This is fascinating when you think about it from the perspective of a total addressable market expansion story, but this data is not really actionable for NIO at this moment in time. The US market isn't open to NIO today. The regulatory hurdles, political dynamics, and security concerns, they're all a real thing. But could they change in the future? Sure, but I'm not betting on US expansion within the next 12 to 24 months for NIO. What this does tell me is that there's underlying demand for affordable, feature-rich EVs, and if NIO can succeed in China and in Europe, the US could be a future opportunity if they can address regulatory hurdles and data privacy concerns. But that's a 2027-2028 story, not a 2025 story. Okay, so let's connect the dots because these stories are all telling us something when you connect the dots yourself and look at them closely together. Story one, institutional money. RWC is building a position after the turnaround becomes pretty visible. Story number two is that NIO's infrastructure moat is accelerating. 90 million swaps and 100K daily. Economies of scale are clearly kicking in. Three is that there's latent demand for Chinese EVs in the US. Even with privacy concerns, the data is suggesting that the products in China are compelling. So what does this tell us? Smart money isn't waiting for Q4 profitability to be achieved. They're positioning themselves before the announcement. If you wait until NIO reaches profitability, the stock could be up 30 to 40%. RWC is buying the setup, not the result. Second is that the infrastructure story is real and it's compounding. 100 swaps per day isn't just a vanity metric. That's usage. That's customer stickiness. That's the moat getting wider. Third is that NIO's problem isn't product market fit. It's execution and profitability. The survey showing US demand proves that their cars are compelling. The battery swap numbers prove that Chinese customers love the experience. The question was never, do people want this? The question was always, can NIO make money doing this? And that brings us back to the now less than 70-day countdown. So here's how I'm thinking about all of this. RWC's $14.5 million purchase is a data point, not a directive. They're a value-oriented fund that saw an inflection in the fundamentals and took a position. That's a mildly bullish signal. But let's be clear, they put 1% of their portfolio into this. That's not bet the farm conviction. That's attractive risk reward given the setup conviction. And they're right to be measured because even with record deliveries, accelerating battery swaps, and execution, NIO still has to prove that they can turn all of this into profit. At the end of the day, NIO is still a speculative bet. That's my perspective as someone who's long on NIO and invested in NIO and has been covering them for so long. NIO's transitioning from will they survive to will they be able to scale profitability. That's progress, that's real, but it doesn't mean that the risks are gone. What we're betting on is execution on the 3-brand strategy, which by the way is working so far. Scaling production to meet demand That's in progress. They need to hit 15K delivered per month with the ES8 by December, hitting Q4 profitability less than 70 days to find out, and sustaining profitability beyond Q4. That's the real test. RWC is betting that at these share prices that it's just asymmetric upside with NIO. I think that's reasonable, but of course not a guarantee. Look, last week's video or videos were about understanding the stakes. Today's video is about understanding the setup. An institutional fund put $20 million in NIO after watching a turnaround. They're not buying the hype, they're buying the inflection. Battery swaps hit 90 million with acceleration that's getting faster, not slower. That's infrastructure momentum. And there's latent demand for the vehicles even in markets where they can't officially sell yet. None of this guarantees Q4 profitability. None of this means the stock goes up tomorrow, but it does tell you that the pieces are moving in the right direction. RWC made their bet. They think that NIO at these prices is attractive enough for a 1% position. I'm still long. I'm still watching execution, and I'm still clear-eyed about the fact that the next less than 70 days are going to be very telling about if NIO is going to be a growth story or another what this could have been story. Smart money is positioning. The only question left is, are they early or are they right? We'll find out soon enough. I'm Obi. Happy Monday. This is Courtside Financial. Please make sure to like the video, hit the subscribe button, click the notification bell icon, and leave a comment down below. All your engagement really does go a long way in helping out the channel, helping us to reach and serve a broader audience. I appreciate you all. Goodbye. Have a good evening.